Greetings, and welcome to Clean Energy Fuels fourth quarter 2020 earnings conference call. At this time, all participants are in a listen-only mode. A question-and-answer session will follow the formal presentation. If anyone should require operator assistance during the conference, please press star 0 on your telephone keypad. Please note this conference is being recorded. I will now turn the conference over to Robert Vreeland, Chief Financial Officer. Thank you. You may begin.
Thank you, operator. Earlier this afternoon, Clean Energy released financial results for the quarter and year ending December 31st, 2020. If you did not receive the release, it is available on the Investor Relations section of the company's website at www.cleanenergyfuels.com, where the call is also being webcast. There will be a replay available on the website for 30 days. Before we begin, we'd like to remind you that some of the information contained in the news release and on this conference call contains forward-looking statements that involve risk, uncertainties, and assumptions that are difficult to predict. Words of expression reflecting optimism, satisfaction with current prospects, as well as words such as believe, intend, expect, plan, should, anticipate, and similar variations identify forward-looking statements, but their absence does not mean that the statement is not forward-looking. Such forward-looking statements are not a guarantee of performance, and the company's actual results could differ materially from those contained in such statements. Several factors that could cause or contribute to such differences are described in detail in the Risk Factors section of Clean Energy's Form 10-K filed today. These forward-looking statements speak only as of the date of this release. The company undertakes no obligation to publicly update any forward-looking statements or supply new information regarding the circumstances after the date of this release. The company's non-GAAP EPS and adjusted EBITDA will be reviewed on this call and exclude certain expenses that the company's management does not believe are indicative of the company's core business operating results. Non-GAAP financial measures should be considered in addition to results prepared in accordance with GAAP and should not be considered as a substitute for or superior to GAAP results. The directly comparable GAAP information, reasons why management uses non-GAAP information, a definition of non-GAAP EPS and adjusted EBITDA, and a reconciliation between these non-GAAP and GAAP figures is provided in the company's press release, which has been furnished to the SEC on Form 8-K today. With that, I will turn the call over to our President and Chief Executive Officer, Andrew Littlefair.
Thank you, Bob. Good afternoon, everyone, and thank you for joining us. On last quarter's call, I spoke in some detail about Clean Energy's future and the expansion of our renewables business. I'm pleased to say that since that time, the pace has continued to accelerate on both the upstream production side as well as the downstream demand side for renewable natural gas. This should keep us in a great position for maintaining our lead in providing RNG to the transportation industry. And I will speak more about that in a moment. In the fourth quarter of last year, we delivered 96 million gallons of fuel, which was slightly down from 103 million gallons delivered in the same quarter a year ago. Due to COVID, we experienced softness in airport fleets and transit, but we were pleased that other sectors performed very well, like refuse and heavy-duty trucking. Volume for the full year of 2020 was 382 million gallons, down 4.6% from 2019, which was 400 million gallons. This was quite an accomplishment considering the significant challenges in the transportation industry brought on by COVID. I want to congratulate the Clean Energy team for making this happen and overcoming the obstacles of operating in the tough environment that we've been in. We kept all of our stations open and all of our customers served. Refuse and trucking actually grew their volumes in 2020, which is encouraging as the country sees the light at the end of the COVID tunnel. Our revenues for the fourth quarter of 2020 came in at $75 million compared to $119 million from a year ago. The big difference was a $47 million retroactive revenue gain in Q4 2019, which represented 2 years' retroactive gain from the alternative fuel tax credit. This was only $5 million in Q4 2020. It was good to see Congress pass the extension of the alternative fuel tax credit at the end of 2020. Importantly, this was the first extension in several that was coming for a year and was not for retroactive gallons, which we hope is a good sign for bipartisan support for the AFTC for the future. The company's balance sheet continued to improve, ending the quarter and the year with $138 million in cash and investments. Our adjusted EBITDA was $45.1 million for the year, which is what we guided to last May when COVID kicked in. As I mentioned at the top of my remarks, since first introducing our renewable natural gas fuel in 2013, Clean Energy has gone through a significant transformation from selling exclusively fossil fuel natural gas to the transportation industry. Sales of RNG have steadily risen, and it has become a larger and larger percentage of our overall fuel mix, now over 70%. But we believe that with the pressure on reducing greenhouse gases and carbon by everyone from investors to consumers, along with the increasing understanding of carbon-negative RNG, we are only at the beginning of what will be a game-changing revolution in fueling. RNG has gone from being a niche product to one where the demand is outpacing the current supply. Fortunately, we have had a continued focus on ensuring a consistent supply and have been able to offer more and more RNG to more and more customers. We now have an expansive portfolio of over 30 supply sources, which allows us the flexibility to move our RNG supply depending on customers' needs. That is why the announcements we recently made are so critical. Two of the world's largest energy companies, both of which have made significant pledges to decarbonize their portfolios, have agreed to individually partner with Clean Energy to develop more carbon-negative RNG. The two JVs with Total and BP that we announced at the end of last year and recently finalized represent a potential $500 million of equity that can be substantially levered to develop RNG projects to produce negative carbon fuel that will eventually flow through our infrastructure and onto our customers. We would like to believe that Total and BP, which often compete with each other, signed on with Clean Energy because of our good looks. But in reality, we are the perfect partner. No other company has more experience in monetizing and trading federal and state environmental credits. And more importantly, with the largest fueling infrastructure, we provide an RNG pathway that is the most valuable, which is at the nozzle tip. We have already signed up dairies for the new RNG production facilities, which can be funded by these JVs. Increasingly, dairy farmers around the country are realizing the environmental and economic benefits of adding RNG production to their facilities. An RNG digester at an agricultural site, like a dairy, solves their own methane emission issue, as well as contributes to tackling the climate change overall. It also helps with our other environmental issues like groundwater, and it gives the dairy farmers an additional significant revenue stream. RNG as a fuel is not a niche, and the potential for additional supply in the U.S. is significant, well into the billions of gallons a year that have yet to be developed. The RNG supply from these dairies that comes online over the next several years will help to ensure a steady supply of RNG that goes directly into the tanks of our growing number of natural gas fleet customers. But, and this is a very important point to understand, the RNG that we generate can be the green feedstock for other alternative fuels, including hydrogen and electric batteries. When using RNG as the feedstock for hydrogen and electricity fueling, we will still generate environmental credits. The RNG feedstock is critical because alternatives like hydrogen and electric are only as green as the fuel that makes them possible. As our customers explore different alternatives when they become available, we can move with them using a feedstock that is rated many times cleaner than most alternatives. In fact, we have experience building and operating hydrogen stations, and we can retrofit our current natural gas stations to add hydrogen. The production facilities that we will be constructing and operating with financing from the JVs with Total and BP will be critical for our future RNG fuel supply. We've also been active in securing contracts for our current demand. Just since last December, we have signed new contracts to enhance our portfolio, representing over 30 million additional gallons of RNG. No other company is better positioned to continue to meet the current demand of fleets for this ultra-clean fuel. And on the demand side, we continue to sign new agreements, highlighted by LA Metro, the second largest transit agency in the country. It announced a deal to purchase approximately 47 million gallons of RNG from us over the next 5 years. Not only is this an impressive amount of fuel, it is a great example of the ease in which a large fleet can switch to RNG and realize a big reduction in the amount of carbon produced by their 2,400 buses immediately. LA Metro had already transitioned from diesel buses to natural gas buses, so the switch from fossil fuel CNG to RNG was seamless and literally happened overnight. As Metro's chief sustainability officer said at the signing of our agreement, quote, "Our use of RNG provides the most cost-effective, equitable, clean air strategy," end quote. I couldn't have said it better. LA Metro joins other transit authorities in making the switch to RNG, including New York City, the country's largest agency. We also recently extended our RNG fueling agreement with Santa Monica's Big Blue Bus and signed a contract with New Jersey Transit to fuel 190 additional buses with an expected 1.9 million gallons of CNG a year. The ready-mixed concrete sector continues to expand with RNG. Our longtime customer, Cal Portland, added 28 new trucks to their fleet of 125 and extended their fueling agreement with us. On the refuse side, we signed new fuel agreements with Garden City Sanitation, Atlas Refuel, Mission Trails, Waste Systems, and others, representing over 3.7 million new gallons or extension of current agreements. We expanded our heavy-duty trucking business by signing new deals with Biagi Brothers, Pack Anchor, STS Logistics, Green Fleet Systems, and Keenan Advantage, which is expanding their fleet of natural gas trucks. These new deals are a result of our Zero Now and Chevron Adopt-a-Port financing programs. As you know, the Chevron partnership specifically targets fleets operating in the ports of LA and Long Beach and has been so well received that the first round of financing for new trucks has been completed. We are now in advanced talks with Chevron to significantly increase the funding and RNG available for the program. So despite the challenges presented by COVID, the transportation industry continues to evolve and seek to do its part in addressing climate issues. There's a lot of pressure on it to do so because 29% of the carbon dioxide produced comes from the commercial transportation sector, which is why we are so bullish on the solution that RNG can provide. We've gone from selling 13 million gallons of RNG in 2013 to over 153 million last year. Our network of stations and customer relationships allow us to deliver substantially more RNG to fleet operators than any other company in the market. In fact, we calculate that we have access to more fueling stations and vehicle fleets than all of our competitors combined. And we believe this is only the beginning. The experience we have gained by being first to market, the knowledge we have accumulated over the years in dealing with customers' needs, and our expanded relationships with partners like Total, BP, and Chevron give us reasons for optimism. And with that, I will turn the call over to Bob.
Thank you, Andrew. Today, I'm going to focus my comments mainly on our outlook for 2021 with some highlights of 2020. I'm pleased to say we finished 2020 as expected. We achieved $45.1 million in adjusted EBITDA versus our guidance of $45 million. As Andrew noted, our cash and investments at the end of 2020 amounted to $138.5 million, which included $49.5 million in net proceeds remaining from our $50 million loan related to our RNG joint venture activity with BP. And while overall volumes declined in 2020, our renewable natural gas volumes grew 7% to 153.3 million gallons delivered in 2020 versus 143.3 million gallons delivered in 2019. All in all, we fared very well under the circumstances of 2020. Looking at 2021, the good news is we are expecting more recovery from the impacts of COVID-19 as the economy continues to pick up, particularly in the second half of 2021. It's also an exciting year as we will expand our renewable natural gas deliveries and particularly increase the mix of carbon negative RNG coming off of dairies. As well, we are moving into 2021 with two exciting joint ventures with two of the top energy companies in the world. We are building on this exciting momentum and look forward to executing on our 2021 plan. Having said that, our GAAP net results will be around break even for 2021, which I will point out includes an incremental $7 million in non-cash stock compensation compared to 2020. This $7 million year-over-year increase in stock compensation reflects our higher stock price. Also, I am not including any estimate of unrealized gains or losses from the change in fair value of our Zero Now fuel hedge in our expected GAAP net results for 2021. Neither of these two non-cash items, the stock compensation and the fair value adjustments to our fuel hedge, impact our adjusted EBITDA. Our outlook for adjusted EBITDA for 2021 is in the range of $60 million to $62 million, which is an increase of approximately 35% above 2020. This improvement reflects our assumption of continued economic recovery from COVID-19 and positive contributions from our RNG volume growth, as well as the greater mix of carbon negative RNG. Volumes are expected to return to more normal levels in the back half of this year, exiting 2021 with a fourth quarter year-over-year run rate increase of approximately 12 to 15%. For the year 2021, volume is expected to grow 6 to 9% over 2020, again reflecting a continued impact of COVID-19 in the first half of 2021. Still an improvement from our 5% decline in overall volumes that we saw in 2020 compared to 2019. RNG volumes are expected to grow around 10% as a subset of our overall volume growth, with the volume of our ultra-clean negative carbon RNG growing tenfold over 2020. Total revenue is expected to range from $320 million to $335 million, with this range meant to accommodate fluctuations in natural gas costs that impact our retail and certain contracted prices we charge customers. It does not include any non-cash fuel hedge changes that likely will arise during 2021, but that have no impact on our adjusted EBITDA. Within our total revenue, we are assuming approximately $20 million of alternative fuel tax credit in 2021, and our station construction sales to be slightly higher by 5 to 8% over 2020, as we have a steady slate of construction projects and solid backlog moving into 2021. Our effective margin per gallon for 2021 is expected to be within a range of 22 cents to 26 cents, noting that the effective margin per gallon for 2020 came in at 22 cents. With assumed economic recovery in the back half of 2021, a relatively stronger RIN credit price over what we saw throughout 2020, and lower carbon RNG in the mix, we would expect to see our effective margin per gallon in 2021 move up from where it was from 2020. Our overall gross margin on all revenues for 2021 will be around 38%. Our 2021 SG&A is expected to range from $77 to $84 million. Keeping in mind, this includes approximately $10 million of stock compensation compared to $3 million in 2020. We will also see some increases associated with the growth in our RNG business activities. We are expecting positive cash flow from operations for 2021 in a range of $45 million to $55 million. Our purchases of property and equipment are expected in a range of $25 to $31 million, which is relatively consistent with recent run rates and primarily represents known station builds and upgrades associated with assured volume. Now, specifically on the joint ventures with Total and BP, those investments will be accounted for as equity method investments, so not consolidated, with us putting up to $50 million in each joint venture, representing our 50% interest in each joint venture. Also, as we had announced in December, Total has agreed to make $45 million available to us to build fueling stations to support long-term contracted RNG fueling volumes, with this separate capital expenditure possibly reaching $75 million in 2021. We are actively addressing our capital needs associated with these exciting growth opportunities. With that, operator, please open the call to questions.
Thank you. If you would like to ask a question, please press star one on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star 2 if you would like to remove your question from the queue. And for participants using speaker equipment, it may be necessary to pick up the handset before pressing the star keys. Our first question is from Eric Stine with Craig-Hallum. Please proceed with your question.
Hi, Andrew. Hi, Bob.
Hi.
Hey, Eric.
Hey, so, I don't know if you're, it seems like you're breaking some news here today in that I don't believe you'd announced that you'd finalized the JV with BP to this point. So I guess maybe confirm that, hopefully that's not something that I've missed here. But just curious what that looks like versus the JV that you announced earlier this week with Total, because that one was upsized a little bit and had some language about what that could be long-term that was increased versus when it was originally announced as an MOU in December.
Sure. Eric, you did pick up on that. We signed that, finalized that agreement with BP this afternoon. So you heard it here first. And we're excited about both of these joint ventures. I mean, as I said in my remarks, I mean, it really puts to work about, potentially $500 million of equity. As you're right, the Total JV has actually been kind of upsized there, where we can each contribute up to $200 million of equity. So when you put the leverage on top of these, I mean, you could have north of $1 billion, $1.2 billion for these projects. So it's exciting for us. The BP joint venture already has 2 projects that are in process, up and running. Not running, but I mean underway. And we've signed sort of the initial agreements for the first project in the Total joint venture. So we're going to try to be as expeditious as we possibly can, bringing these projects online. These are all dairy projects and super low negative carbon dairy projects, and they're coming in. We don't have the exact pathways on this, but some of the most recent dairies we've seen, are negative carbon in the 350 range. So these are, dramatically lower carbon than the other fuels out there, and so they're powerful.
Got it. And just to confirm on timing, obviously you're going to, as you said, expeditious. I mean, is this something that we still should think about as more of a, where you'd start to get the initial benefit below the line, very late in 2022? And just curious if you're able to or willing yet, or something we need to wait for, to just talk about kind of income contribution per project.
Yeah, you're right, Eric. These projects take a year to 18 months, to really. So you're right. That's when you could expect those to be able to contribute. The projects themselves don't take long, but by the time you get the pathway charted and certified, I think it's safe to say that it's between a year and 18 months before you could really have those contributing. Now, the projects that we signed in December, and it's several of them, as I mentioned, 30 million gallons. There's low CI dairy projects in that. Those are further along, right? And those are coming on now, so you'll begin to see that contribution in 2021. And there will be more. I mean, we're working on it. I mean, look, this is a fun right now, an exciting time. I mean, as I mentioned in my remarks, there's billions of gallons of potential of low dairy. And when you look at all the sources, there are studies that show that it's approaching, 25 to 30 billion gallons. So lots of money will go into developing this. We like our position because we have those nozzle tips, which, I always talk about that, but that is a key differentiator between us and others, because we get a chance to then bring a lot of that to our fueling network and to our customers. But when you look at the economics and the low carbon nature of RNG versus the other alternatives that people are talking about. This is here today. It operates in vehicles that are on the road today. It can be dropped into the fleets, and it's unique. And so I think as fleets look at their other alternatives, they're going to turn to RNG until those other alternatives are ready for the market.
Right, got it. And maybe a good segue. I know you've got a goal to have 100% of your owned station volumes to be RNG by 2025. Now that you've got BP, Total, Chevron, all committed to the low CI RNG, any thoughts on what type of percentage you might think about out in 2025 when you reach your goal? What percentage could be low CI?
Oh boy, I haven't. No, you be making it up. I mean, it's we're started out. You heard Bob. We'll work on. You heard Bob say that this year we're going to increase our low CI by tenfold. Okay, but we're starting out at a very low base on low CI, and we're well positioned because we are taking the lion's share of low CI that was already developed, and so we're growing it substantially. We will begin, I think, over time to be showing the carbon of our portfolio of fuel, and soon that'll go negative, which is kind of interesting, isn't it? That we could be selling hundreds of millions of gallons and it actually is negative carbon, all of it, when you blend it all in. But environment. But I don't know. We'd have to get back to you, Rob.
Yep.
Eric, I don't know, the contribution on low CI versus other.
No, that's fair. I thought I would give it a shot, but to be continued.
It'll increase.
Yes.
Kind of
it'll
each
increase.
year that's going to go up. So, but it may be a stretch to say we get all the way to 100% of all low CI. But
obviously we're going to want to use low CI if we can, right?
It'll be meaningful. Particularly because of the value of that as well. I mean,
Yep. No, fair enough.
Yeah.
Fair enough. Maybe just last one for me, and I do appreciate all the details because you certainly gave more on the outlook than you ever have in the past. But when you think about the volume dynamic, just maybe some thoughts by segment. Knowing that it's all likely back half loaded, but maybe volume improvement year over year expected by segment would be great.
Okay. Well, from I'll call it kind of the core markets, refuse, transit, fleet, trucking. Those are all they'll see good volume increases. I mean, the fleets and trucking are going to be, in the teens percentage-wise because they were fairly significantly impacted this year. So we see them
fleets and transit.
Fleets and transits.
Yeah.
Trucking as well. We see that improving and in the same kind of bucket, and that's just because that market is really evolving. So you have transit and fleet that are kind of coming off of tough years. You have trucking that is really gaining momentum. And then refuse is kind of steady Eddie.
Last year, refuse grew at 8, right?
Yeah, and so exactly. So it was even a little uptick on its growth rate, but then it would be kind of close to that. So and then kind of the rest of it, you get into kind of some bulk, you get into NG Advantage and others. So you end up kind of in that overall 6 to 9, but frankly, looking at more at the fourth quarter is really what we were, where we see kind of a 12 to 15% year over year, which should start to equate to more of an annual rate on that. So 2021 still got a little bit. As we know, we're seeing good signs, but we're not quite out of the woods on the COVID-19.
Got it. Okay, thanks.
Our next question is from Manav Gupta with Credit Suisse. Please proceed.
Hey guys, so you talked about BP and Total. You mentioned Chevron, but I want to highlight something. Chevron today morning at its Analyst Day event indicated that they are looking to grow their RNG by 10 times by 2025. Now, one of the questions I did ask Mark Nelson, their head of downstream, was how do you plan to distribute it? And they said, look, we can look to distribute it, but there are partners and you are a key partner. So I'm just trying to understand, like BP and Total is fine, but one of your partners, Chevron, is going to grow its volume 10 folds. And how do you fit into that? How does Adopt a Port program fit into that? If you could talk a little bit more about Chevron's and its ambitions to grow RNG and how you could fit into that.
Right. Well, Chevron's a very valued partner of ours, right? And we take a significant portion of all the dairy gas that they're producing today. So it comes to us under contract. We've increased that over the last year. And then, of course, we have, I think, what's a really innovative program with them. And I mentioned, Manav, that we're expanding it. We proved it out in the last 6 months, and that's at the Port of Los Angeles. We call it Adopt a Port, where Chevron's providing incentive funding to our customers, truck owners in the Port of Los Angeles, as they look at, they're being forced or faced with, over the next couple of years, moving toward either electric or natural gas RNG trucks at the port. That's kind of their choice, or pay a fee to operate a diesel truck, and it's got to be a newer truck on top of that, newer diesel truck, if they're able to operate it. And so we're actually able to use, Chevron has worked out a program with us where we're able to provide incentive funding to help defray the cost of that new natural gas truck, which will use RNG from Chevron through our station. So it's kind of a win-win-win. It's a win for the air quality down in the port. The carbon and the tailpipe emissions in the Port of Los Angeles are among the dirtiest in the United States. So it's good for the people that live there. It's good for the truck owner because it gives them a economic way to operate for the future as compared to their other alternatives. It's good for, we're moving a significant portion of all the fuel that Chevron's beginning to produce out of their dairy projects. And of course, we're a partner because we're participating at the nozzle tip and participating that way. So far, we're not in the upstream relationship with Chevron. We're really on the downstream and in the marketing side. So we'll continue to work with them. I was on with the president of Chevron today talking about that as they look at different ways in their infrastructure. We're here to help in any way we can because, after all, we've built 718 station projects over the years, more than anybody else really in the world. And so we understand this. And so we're excited about that relationship with them. And I saw, as you did, that was a bold statement that this is going to be a significant way for them to work on their decarbonization effort.
Perfect. A quick question here was, we saw Amazon order 100 CNG RNG trucks. Given they're trying to hit their carbon neutrality, most likely they will try and go for negative RNG. I mean, CNG will not really get them to negative carbon neutrality by 2040. So again, you haven't signed a contract, but you have contracts with UPS and FedEx. So help us understand what's the unique proposition of clean fuels. Why would somebody like an Amazon or anybody else who's ordering 1,000 RNG CNG trucks and trying to move them from long haul would actually like to sign up with CLNE versus anybody else?
Well, we have the largest network, right, in the United States. And so I think that as fleets like that, we've seen this over the years, that national players want to be able to have the optionality to move their vehicles where they operate. And so that's why often that we're able to participate with these large fleets. That's why we have that, I think, still remaining 6 years, 150 million gallon RNG contract with UPS. And so you know that we have the advantage that we have the most RNG, we have the most flexible RNG portfolio. That's another reason why a large fleet would want to work with us. We don't have the dilemma for them where we have one source that if something happened to that, look, these are like anything else. Occasionally these projects will go down and then all of a sudden that fleet is not able to get the RNG. We have the ability to move our RNG around, and so we give flexibility to the fleet. So it's our network, it's our know-how in terms of developing stations for these kinds of large players, and it's the RNG supply that we have. And so I didn't specifically say that we have a deal with that fleet that you're talking about, but that's why fleets like them would look to clean energy, I think, because we have those capabilities.
And the last question for me was, how much of with your existing infrastructure, without spending any more capital, forget the maintenance capital, but with your existing infrastructure, how much more volumes can this existing infrastructure handle across the United States without spending capital into it?
Yeah, no, it's a good question, Manav. We like to think that our available capacity at the stations that we've already built and paid for is in and around 500 to 600 million gallons. So without spending any significant capital, we can accommodate that much volume. So that's another advantage, is that we have stations that have unutilized capacity that's available today, that are up there, that are there, installed, and ready to go.
So if I get it right, you're doing 100 to 120 per quarter. What you're telling us, you can literally double the volumes through the same infrastructure without spending a dime?
That's right.
Thank you for taking my question.
Maybe a little more than double. Right.
Okay. Thank you for taking my question.
Thank you.
Our next question is from Rob Brown with Lake Street Capital Markets. Please proceed.
Good afternoon.
Hey, Rob.
And just following back up on Chevron and the port program, you said that first phase was completed. How many trucks went through that phase, and what's the potential size of kind of a phase two?
I don't know that we've said that, Rob. We're making news here today. It's about 185 to 200 trucks in that first phase, and they're not all they're all contracted. They're not all on the road yet, but the incentive dollars have been obligated, and contracts for the most part of those 200 are all done. And now we're working on kind of the next phases, which should be significantly more than that. So, I can envision that. And by the way, there was just another round of grant funding, which goes kind of hand in glove with this Chevron incentive money, for another 350 to 400 trucks, which will round out. That'll happen in the next 3 months. So you'll have about 700 trucks funded. There's about 250 trucks already operating the port, and there's about, let's call it 200 in this Chevron program, and then about another 700 trucks. They haven't all signed on to our program yet, but I'd like to think that they probably will, because it's very attractive. So, you get to over 1,000 trucks, 1,200 trucks out of kind of a daily operating. There's 16,000 trucks in the port, but there's really 10,000 that operate daily. So you're beginning to make significant penetration at the port. It's really a very interesting test bed for something that's actually operating today and has really great emissions. Kind of goes under the radar a little bit. I mean, I think at the same time, there's a handful of test electric trucks down there, a couple, and I don't know if there's any fuel cell trucks. There may be a couple of Toyota trucks down there that are testing as well. So there's a lot of experience being gained doing the duty cycle that needs to be done. That's very difficult at the Port of LA and Long Beach.
Okay, great. That's excellent color. Thank you. And then I think you mentioned a potential Capex addition of about $75 million. What is that dependent on, and how many stations would that fund?
Well, that's dependent on growth in the fleet sector, right? In the trucking sector, for kind of this RNG growth that we see coming. And that would get you about another 25 kind of, large fleet heavy-duty truck stations. Those will be under customer contract, though. They're not spec. We're out of that. We're out of the spec business.
Yep. Okay, good. And then last detailed question, Bob, what was the margin per gallon in the quarter?
It was about 23. 23
Thank you.
cents.
I'll turn it over.
Yeah.
Any other questions, operator? I think that might do it. Oh, we have Pavel. Pavel.
Yes, we do. Pavel Molchanov with Raymond James. Please proceed.
Yeah, thanks for for taking the question. In the 21 guidance for 60 to 62 million of adjusted EBITDA, what's the implied value of the federal tax credit AFTC revenue?
20 million.
20?
20.
20. Okay, so that's pretty similar to this past year's level, correct?
It is, Eric. Yeah, and yep. We're because we still do have some kind of AFTC gallons, if you will, being impacted by COVID for the first half of the year. So, if that goes up, maybe that number could go up.
Okay, got it. And also, when we think about the cost of crude, which is now pushing $70 Brent, it's safe to say higher on the front end of the curve than just about anybody would have guessed, 100, 120 days ago. Is there any relevance of that for your economics in 21? In other words, are you making any call on where diesel goes?
Well, I don't know that the numbers that Bob, just gave you would Pavel, I'll let him speak to it. He may look at me funny here. I mean, I don't know that as we've given that guidance here, we've tried to adjust for a 60, let's say if the year finishes out on an average of $65 a barrel or something like that. But clearly, $65 oil here has made a marked improvement, an increase in diesel prices, right? I mean, at the depths of, forget the negative print, Pavel, right? But at the depths of COVID back in April, May of last year, we saw diesel prices $1.60 in certain of our markets in the Southeast in that pad. Today, the average diesel price in the United States is $3. Out here this morning at the Port of Los Angeles, I got the report, it's $3.89. So our prices have moved up. Our feedstock, the natural gas, is stable in comparison, and so no, it's significant for us.
That's exactly what I was kind of looking at. And lastly, this one's a little just broader point. Historically, LNG volumes have declined every year since 2014, and obviously this past year there was COVID impact, but of course not before that. Is there something structural going on in that heavy-duty long-haul market that's caused volumes to go from 80 million gallons in 2014 to 60 currently?
Well, Bob's got some numbers here to review, but look, I think the majority of the heavy-duty truck space is moving towards CNG, not LNG. And I mean, that's it in a nutshell. I mean, you're seeing more as this market has developed so far. I still think there may be some LNG, as it gets a little bit more mature out of route type deliveries, sleeper cabs could avail themselves to LNG. But the industry has made tremendous strides on the fuel package on board the vehicle, the range of CNG, the delivery of CNG in the urban areas. As more trucks over time, kind of getting truck drivers at home at night has led to slip seating, and it has meant kind of more super regional trucks than out of route type, what we used to think of a truck driver or truck driving. So I think CNG is a very super competitive fuel, and so more of it's going to CNG than LNG. And look, we've had to make adjustments. I mean, there's no secret here. I mean, we built some LNG stations years ago, 10 years ago now, right? Probably too many. And so we've made adjustments to that. And good news is we can make LCNG, right? We can put in some vaporization equipment to have CNG at our stations. And in some cases, we've had large fleets. We have great locations, right? And so we've made the additions where we've needed to based on customer demand to put CNG in.
Right. Is the margin profile meaningfully different between the two fuel categories from
CNG has better margins. CNG has better margins.
Okay.
So it's not a bad thing. It's probably a good thing.
Yeah.
Because there are a couple of things where LNG has more range. LNG tank package is cheaper, so the truck can be cheaper, but the fuel tends to be a little bit more expensive, and the handling of it's a little bit more complicated. So CNG is awfully tough to beat.
Understood. As long as you guys are making money, either way, right? All right, thank you, guys.
Exactly. I mean, look, if there's a mistake, is we probably built more LNG stations than we should have back then, and because we really felt like at the time, CNG look, you have to go back with me. Remember, Pavel, we bought the first 100 trucks to prove out that this would work. And it was in a port application, so it was really a drayage application. We didn't know if over-the-road trucking would really work, and we didn't really have the range for it to work. We were limited on range. But look, the industry responded beautifully, and the tank packages today in the back of the cabs are sweet. And you have 650 miles of range, which we didn't have in the beginning. And so CNG is a really tough competitor to LNG today.
Appreciate it.
You bet.
This does conclude our question and answer session. I would like to turn the conference back over to management for closing remarks.
Well, thank you, operator. We want to thank everyone for listening on the call this afternoon and look forward to updating you on our progress on the next quarter. Good afternoon.
Thank you. This does conclude today's conference. You may disconnect your lines at this time, and thank you for your participation.